Hello, everyone. Good afternoon. Hmm. Good afternoon, Christina.
Yes,
Good afternoon. You are from which country?
I'm from Russia.
Oh, you are from Russia. Okay.
Good
And
morning, Professor.
good afternoon. How are you?
Oh yeah, it is afternoon here. Sorry.
Stavros, Benedict, Benedict.
Yep,
Good afternoon. You
good
are
afternoon.
from which country?
Germany.
Germany. Oh, okay. Is there any reason you choose Korea to study as an exchange student as Benedict?
Yeah, but the story is a little bit more complicated, to be honest.
Okay, okay, I see.
The short version of it is I work at the same time. Like in Germany, I do kind of a work experience kind of bachelor. So we spend half of our time in the company and half of the time at university.
Uh-huh.
And my boss said, yeah, you have to be back in January. So I had to look for a school which ends its semester in December, and Korea was just the nicest option that made that possible.
Okay, yeah, sounds yeah, pretty complicated. Okay, so anyway, I think I hope your choice was yeah, was good. Yeah.
Yeah, I'm happy about the choice so far.
Okay, good. Good afternoon, everyone. Nice to see you guys back again.
Good afternoon.
Good afternoon. Good afternoon. Oh, can you see the screen? Where is it? Where is this? Can you guys?
Is New York.
Yeah,
Park.
you've been there?
No, but this park is really famous.
Yeah, Central Park, right? Have you anyone who been there here? Anyone? Anyone been who been to Central Park?
Not yet.
Not. Oh yeah, not yet, but you will, right?
Yes.
Definitely. So you're going to work on the Wall Street, right? Yeah, why not? Okay, so the reason I pick up this picture of Central Park in New York is just try just uh, I hope that you guys take work in this Central Park in your mind. Okay, just imagine that you are working in this Central Park, studying the fixed income. Okay, so what I'm saying is that I'm trying to make this topic, the fixed income, as easy as possible. But so we're gonna have uh, two lectures about fixed income. Okay, so first lecture is going to be kind of an overview of a fixed income, what fixed income is about, and the second one is a little bit yeah uh, it's complicated, a little bit not as much as Benedict story, but a little bit complicated. Okay, so but before we go to understanding and valuing fixed income, I think we have some slides to follow up from the previous lecture, right? Time value of money and DCF evaluation. So first of all, do you have any questions about anything from the previous lecture before we move on to the remaining slide? No? Okay. So I'm gonna be a little bit faster today because there are lots of slides to cover. So, but still, if you have any question, jump in, okay? Okay, so let's imagine you're gonna buy this Mercedes AMG GT43 four-door coupe, okay? And the market, the price, manufacturing MSRP anyway, MSRP is 92,500, pretty expensive, right? For you guys and for me as well. So if you go to the dealership, dealership of a Mercedes, then so you're gonna have a sit and talk conversation, having a conversation with a dealer, right? So then unless you're gonna pay in a lump sum amount at once, you're gonna pay. You're gonna pay a monthly installment, right, over some period. So let's assume that the total period is 72 months, and your down payment of 10,000, right? And then let's say no estimated net trading value, and then after considering taxes, fees, and this down payment, the total amount to finance from the Mercedes financials, whatever, is $90,950,000.38. Okay. So then, based and the interest rate, annual percentage rate, annual percentage interest rate, let's say 5.19%. Based on these conditions, so then I think you should be able to find out what would be the estimated monthly payment, right? So if you simply if you simply given the this amount from the dealer, then okay, so that's fine. But I think it is also good to be able to calculate on your own this monthly payment, right, based on these conditions. So that is what I'm going to explain. Okay, so how can you calculate this estimated payment? So first of all, what you should understand is that we previously covered present value, future value, right? Present value is the discounting of cash flows in the future to the present, and future value is compounding, right, of the present, of the compounding of the present cash flow to the future, right? So present value and future value, present value is reversible future value as far as the interest rate is the same, right? So the only difference from the previous explanation on future value and present value is that previously we talked about we talked about only one cash flow, right? We have at the moment $1 million or whatever dollars, and what is the future value of this $1 million, or whatever the present value of $1 million in 5 years from $1 million $1 million in 5 years back to the present time, right? But the only difference is that we have cash flows every year, right? Okay, so we have cash flows every year. So then what we did we have cash flow every year, and the future value calculated by compounding for the one period at a time. Okay, so yeah, here we want to know the future value in 5. Okay, in 5. So what is the future value? 2000 year one in 4 years. 1, 2, 3, 4 years. What is the future value of $2,000 in year two? At 5 in 3 years, right? So we simply compounding. Just a minute. We're simply compounding this cash flow to the year 5, okay? But here, so let's see. So look at this chart. So year 1, 2000. If you multiply, let's say interest rate is 10%, okay? So then 10%. And the square root of 4, right? So then you're gonna have a future value in 5 of $2,000 in year 1, okay? Or $2,000 in year 2 if you compound in $2,000 at 1.1 3 times 1.1 interest rate. So then you're gonna have this future value, square root of 3, okay? So pretty, yeah, logically speaking, yeah, pretty understandable, right? Easily. You guys understand what I'm saying? Okay, okay, understandable, yeah? So this is a, so if you have cash flow every year, and if you want to know the future value in specific period, let's say in year 5, then depending on the when the cash flow is made, use compound. As far as this interest rate is annual interest rate, you compound the remaining future years. You multiply remaining future years. Okay, compound. Sorry, you compounded this cash flow to the remaining future years. So the key is that you have this 1.1, right? 1.1 one time and 1.1 scale 2, 1.1 scale 3, right? This is the year remaining the years to the future, right? Okay, and then this one is 1 plus 0.1, right? Then this is interest rate. So this interest rate should be annual rate, right? If we are talking about yeah, if it is the annual rate, then you this period should be also annual, okay? That's important. If this interest rate is 7 year, then this period also 7 year. So let's say interest rate is 0.05, right? This is 7 year, right? So then you have to for 1 year, you have to multiply 2 times, right? Okay, so I think you guys understand. And the present value is just reverser, okay? Simply speaking, just reverser, right? So you want to know the present value of these cash flows in the future back to the present time, right? So then you simply divide these cash flows discounted, sorry, not dividing, discounting, okay? Discounting these cash flows is, in the future by this interest rate. So this time here, the interest rate is 6%, right? So annual interest rate 6%. So annual interest is 6%. So year 5, you should discount 1, 2, 3, 4, 5 years, right? That's why you, yeah, this cash flow discount at this rate scaled by, okay? Not scaled, powered, how to say, yeah, 5 times. So I'm not a native speaker, so sometimes my English is a little bit broken, so please understand. Okay, so the only difference from the previous future value and present value is that we have cash flows every year. Okay, okay, so then you may think figuring out this calculation may be related to this related to the calculation of this amount, right? So let's say the interest rate is of 5.19, right? That's the difference, and we don't know this estimated amount, but we know this present value amount. What is the present value amount in this if we take this case? What is the present value in this case? Pigeon, Pinshin, I'm sorry, Pinshin, Pinshin, so Piyisin, Pinshin. Sorry, my pronunciation is pretty terrible. Jiangyu.
Yes, I'm here.
Ah, okay. So so in this case, what is the present value? What do you think is the present value? So we have annual interest rate, right? First of all, you understand this explanation about future value and present value?
A little bit confused about the future value.
Okay, so then please ask me which one makes you what makes you confused? Please, what makes you confused? What makes you confused?
So it plus like 1.1.
Okay, yeah, 1.1. So here, interest rate is 10%. Okay. So in the previous slide, we future value, we understand the formula. $1 multiply 1 plus interest rate, right? And is the future value, right? So let's say future value year 1, then $1, let's say $1 multiplied by interest rate compounded at this rate and year 1, right? So this is a future value. Then right now we are talking about 10% interest rate, right? Then 0.1, right? Year 1. Then in this case, the cash flow in year 1 is $2,000, right? And 2,000 and multiply 1.1. Then because we are now not year 0, but this is now, right? But we are in this cash flow is year 1. So if you want to know this cash flow year 1, the future value of year 1 in year 2, then you simply multiply 0.1, then you're gonna have future value of, sorry, this is then this future value, because this one is the year one amount, right? So that's in the end, this one is gonna be the future value in year two. This is maybe you may be a little bit confused. Let me explain again. Okay. Yeah. So the thing is that your compounding future value is compounding, right? Compounding. Compounding means that you have a cash flow, right? Cash flow, whatever, and multiply 1 plus interest rate. So if its interest rate is annual rate, right? So then it means that this cash flow will be compounded every year at this rate, right? At this rate, because this annual rate. So here the case is that annual rate is 10%, right? So then if you want to know future value, then cash flow multiply 0.1. But if you want to know a cash flow in 1 year, you simply multiply 1 time. If you want to know cash flow, future value of this cash flow in 2 years, you multiply 2 times, right? If you want to know future value of this cash flow in 3 years, 3, 4 years, 4, 5 years, 5, right? So if you have if you want to know the future value of this cash flow in 1 year or in 2 years, in 3 years, in 4, 5 years, or 4 years, or 5 years, depending on the future, how many years away from now, you multiply, you compound this cash flow at this rate, 1 year, 2 years, 3 or 4, 5, 3 or 4, 5 years, 6 years. So here the case is that, okay, we have this cash flow in year 1. So we want to know the future value of this 2000 in year 5. Then how many years away from now? 4 years, right? So that's why we multiply 4 times. How about the $2,000 in year 2? We want to know future value of 2000 year 2 in the future value of $2,000. In 3 years. So which means in year 5, right? So then you should multiply 3 times, compound 3 times, because our objective is to know the future value in 5, all the cash flows in the past. Okay, so in the past, the key here, when you the future value, the key is, the point is the future, when the future time, right? Present value point is the present time, 0, 1, the year 0, right? But future value, the point is our focus is on the future time, any specific future time. Here, year 5. So we have to compound the previous past cash flows into the future, right? So year 1, $2,000. If we compound 4 times, right, at this rate, then we have a future value in 5, in year 5. Understand? Zhang Yuan?
Yes, yes,
Zhang Yu?
yes.
And how about others? Still confusing? Still confusing? What is your silence? What does your silence mean? Pretty understandable. Clara, you look pretty serious. Are you okay?
Yes, I am.
Okay. Okay. So teddy bear. There's a teddy bear waving to me. I can't read the Chinese there. Okay, so the present value is just a reversal. Our focus is the present time, right? So we want to move all the future cash flows backward, right? Here, forward, backward. So we have some future cash flows, $1,000 every year. But we want to know what is the present value of this $1,000 in every year up to 5 years. So then we just discount this cash flows at discount rate 6%, right? So the cash flows in 5 should be discounted 5 years, 1, 2, 3, 4, 5 years to be to be present. Year 0, right? Okay. Difficult. Is okay. Still confusing. So then here, my question is, what is the, in this case, is the present value? You know what is more important is not to understand simply what present value is, what future value is. More important is you should be able to apply this concept to the real case. That's more important. So in this case, the present value is this one, right? Total financed. This is present value. So if you have $90,000, right? $90,000, $950,000, $90,000, $950.38. Then if you have this extra money, right? So then you can pay all of the money right now, but you don't have this money right now, right? So you're gonna pay some amount in the future over this period, right? 6 years. So you're gonna pay over the 6 years every month. You're gonna pay some installment. So then this is gonna be cash flow, right? Every month. So and this we have this interest rate. So then since we know this future value and interest rate and the period, we are able to calculate this estimated payment using a calculator or Excel, the Excel spreadsheet. Okay. Is any question, please? Any questions?
Professor,
Yeah.
can you please tell me again what is CF stand for?
CF, cash flow.
Okay, thank you.
Yeah. Any questions? So everybody understand, right? Okay. And jackpot. This one is important one, but I'm gonna come back to this case. I think I have a chance to come back to this case in later lectures. Okay, so I'm gonna come back to this case in another lecture. Okay, in the future. Okay, so I'm gonna skip. Annuities. Annuities is you like a pension, right? Annuities is like a pension. This is annuity, right? Every year, same amount. Okay, annuities. So pensioners receive a fixed amount every month, right? That's the annuities. So if you have fixed amount every year, right? Could be every month or every 6 months, but just for simplicity, let's say you have cash flow every year, right? And the same amount, same cash amount, okay? Same cash flow. Then what is the formula to calculate the present value of these annuities? This is the formula. Yeah. So using this one, as far as you know, the cash flows every year, and then you can calculate the present value of the annuities, right? Using, sometimes you can use, if you want, you can use Excel, the Excel sheet. Using this one, you can calculate the previous the Mercedes case. Okay. Here, no, sorry. Okay, so what's the present value? 90950. Right? So if you have so this is the present value, right? And then you don't know how much you should pay every month, right? What's the period? Period is 6 years, okay? 6 years. And the future value, 0. The interest rate is 5.19. Yeah, this is the annual interest rate, right? That's why I use years, okay? Because this is annual interest rate. If you want to because this is monthly payment, then you should change this interest rate into monthly rate. So then you should divide this annual rate 12, right? So then this one should be 72 months. 72 months. Okay. Annuity. So, but annuity usually means annual payment, right? So let me change into years. Okay. So then, okay, so let's find out this amount. Payment. payment. Okay, payment, rate, annual rate, per period. Period. Just a minute. Six years. 6 years. And PR is no, not this case. Present value. This one. And then future value, we don't know. And what's wrong? Payment. Payment. Yeah. Rate. MPR. MPR. 6 years. Present value. This one. Future value. We don't know. Type. Every month. In the beginning of every month. Then 17,138 is similar. Yeah, this is monthly. So this is annual amount, right? So you should divide this amount. $12. Right. Then is similar. Should be the same. 1,472. 1,470. Then the difference maybe come from this one. 0. No. Okay. The slight difference. Maybe some rounding, so whatever. Slight. Yeah, 1.8. A little bit difference. 90, 95, 3.8. Yeah, yeah, but basically, I think there is something something hidden in this calculation. But anyway, this is the way you can calculate this monthly instrument, okay? Because using this Excel. Did you guys follow me when I did this work? Okay. So go to formula and the finance and payment. Okay, so then you can calculate this monthly payment when you know interest rate and payment period and the present value. Okay. Yeah. Here, I got exactly the same amount. If I use the monthly, if I calculate, convert into monthly, then we can get exactly the same amount. So since I use the annual rate, right, there was a little bit difference. But if you use this monthly interest rate, then you can get exactly the same amount as this one. Okay. Okay. So please do this work for yourself. Okay, then it will be a very good chance to get to know about this present value, future value annuities. Okay, so try to make friends with this Excel spreadsheet, especially this function, the formula. Okay, these are the formula and the finance functions. Okay, try to play with these functions. Okay, so then you're gonna be very good at the concept of present value, future value, and annuities. Okay, so and perpetuity means that if cash flows is permanent, if one specific cash flow is permanent, then what will be the present value? Then you simply discount the permanent future value, permanent cash flow by at the interest rate itself. Okay, so let's say 500. You are gonna receive a $500 every month forever. So then what will be the present value of the case? Then you simply divide $500 divide $500 by the interest rate. Here in this case, 8%. So then the present value is $6,250. Okay, so you should understand because why this formula is like this? Because you see here, this is the present value formula to calculate the formula to calculate the present value of annuities, right? But if t is infinity, right? So then this is going to be 0, right? So then the only thing remaining is R and C, right? That's why perpetuity formula like this, because t is infinity. So then infinity. So then this 1 plus R t is gonna be 0 when t is infinity, right? That's why we have the perpetuity, the present value of perpetual cash flow is the formula of formula for present value of perpetual cash flow looks like this. Okay. And effective annual rate and annual percentage rate, there's a difference. The effective annual rate is less, let's say, here, effective annual rate is interest rate expressed as if it were compounded once per year, and annual percentage rate, interest rate charged per period multiplied by the number of periods per year. Okay, so let's take this case. A typical credit card agreement calls an interest rate of 18% annual percentage rate. Monthly payments are required. What is the actual interest rate you pay on such a credit card? Based on our discussion, annual percentage rate of 18% with monthly payments is really 0.8%, 18% divided by 12 or 1.5% per month or per month. What is the real actual interest rate? So effective annual rate is if you are supposed to interest every month, then the effective interest rate is the let's say here. So this is annual percentage rate, right? 5%, 5.119 is the annual interest rate. But we are supposed to pay every month, right? We are supposed to pay every month. So this payment includes interest rate, interest, right? So so we actually think that the interest included in this payment is 5.9 divided by 12, right? As we did here, right? We think that monthly interest rate is 0.43%, right? But effective interest rate is no. Actually, as this monthly, because the actual interest rate, effective interest rate should be multiplied every month whenever you make a payment. Okay. So 1 plus 0.3 this is the monthly interest rate. This is monthly interest rate, right? But since we make a payment every month, the actual effective tax rate is here. This one is 5.2. No. Here, 5.19. Let's say 0.059. Yeah. So divided by 12. Okay. And 12 months minus 1. That is the effective annual rate. Okay. Because, you know, it takes time to explain this formula. I think I'm gonna make a separate slide to explain why, what's the difference between effective annual rate and annual percentage rate, okay? Because it takes time. So, because I have more slides to cover, okay? So I'm gonna give you a separate slide, okay? To make you guys understood a little bit easier, okay? So I'm gonna give you a separate slide. Okay, so I think you guys may be able to solve this question using based on the previous understanding of future value and current the present value. And if you don't know, you can also refer to this calculation, my own calculation. Okay, so now we are going to talk about the fixed income. Okay, fixed income is, as the name said, the income is fixed. So here, income is fixed, and what kind of income? We usually talk about interest. Okay, interest payment. But here in this world of fixed income securities, we usually call interest coupon payment. Coupon. You like coupon, right? Sometimes if you go to supermarket or wherever, they provide some coupon. But this coupon is a little bit different. Here, fixed income, in the fixed income coupon is interest, and this fixed income usually means bonds. So why we are talking about bonds? Why we are talking about bonds in the corporate finance? In the corporate finance, the reason we are talking about bonds, we are going to talk about after this class on bonds. We are going to talk about this stock. Okay, so the company, the corporations need capital to run their business, right? But there are only mainly two ways to raise capital. One is in the stock market. The other one is in the bond market. Okay, so if you see the balance sheet, right? So this is asset side, this is liability side, this is the equity side, right? But this is the asset side. This asset is financed through this liability or equity, right? So equity means you issue shares to the investors, and then you get contributions, equity contribution from shareholders, right? So equity side is financed by shareholders, right? The liability side, if you want to purchase an asset, you need financing. Then on the liability side, you may make a loan, take a loan from bank, right? Loan. If you have a credit, right? That's one way. The other way is you're going to issue bonds. The company is going to issue bonds. Then the investors purchase these bonds. This is treasury bond, but if it is company, the corporate bond, the people is going to buy corporate bond, right? Which means that they're going to pay cash to purchase this bond. So then the company, have financing. Okay. So they finance all their investments and purchase of assets, or if they want, they may use this the money financed through these bonds or shares to acquire another other companies, merger and acquisition, right? So in the corporate world, there are two main financial market. One is the stock market. The other one is a bond market or fixed income market. Unlike a bond, the stock does not give you any fixed amount every year, right? But the bond give you the bond pays you interest income, fixed interest income every specific period, every fixed period. But there is a maturity, there is an expiration of fixing the bond, but there's no expiration of shares, right? This means that actually the bond market is much bigger than the stock market, right? But the one difference is that the bond market doesn't have any this kind of specific the market, but the bond market is mainly over-the-counter market. No official, there's no official market. It is mainly traded through brokers and dealers. Okay, not ordinary people. Yeah. So the market makers are usually brokers and dealers rather than individuals. So fixed income or bond securities, any investment where the issuer is obliged to make fixed payments on fixed schedule. That is the fixed income, usually bonds. Okay. At maturity, for many fixed income securities, investors are repaid the principal. Principal amount is the, for example, here, the base amount, $1,000, for example. Okay. Principal amount they had invested in addition to the interest they had received. Okay. Bonds issued by governments and corporations are the most common types of fixed securities. Yeah, at maturity, they're gonna receive a principal and any interest remaining. It sounds a little bit, yeah, weird. Okay. Fixed income investors differ from shareholders in not having ownership rights in the company. So shareholders is has ownership rights in the company as a shareholder because yeah, the shareholders are the owner of the company, but bondholders is not the owner of the company. They just credit. They are called the creditors. So they seek interest payments from the company, stable income, yeah, stable income in the manner in the form of coupon payment. Payments of interest and repayment of principal are higher priority claim on the company's earnings and assets compared with the claim of common shareholders. What this sentence means? This sentence means is that income statement. Okay, income statement. If you see revenue and the cost of sales and the gross profit and sales and administrative expenses and interest expense, right? And tax expense, then you have net income. And this net income may be distributed to shareholders. So as you can see from this income statement, this interest payment comes first, right? Before, and the shareholders only maybe get any, if there's any, after this interest expense payment, after payment of the interest expense, the shareholders' share comes in a net income. Okay, that's why the payment of interest and repayment of principals are higher priority claims. On the balance sheet, right? On the balance sheet, this is a liability and equity, and the principal amount of the bond here, right? On the liability side. So equity is simply asset minus liability is equity, right? Not like asset minus equity is liability. We do not calculate like this. We calculate asset minus liability is equity, right? So which means that the principal amount comes first, and then any remaining amount after this liability is may go to the shareholders. Okay. Since fixed income claims they rank above the shareholders' claims in the capital structure of companies, fixed income securities have in theory a lower risk than common shares. In general, right? In general, more secured than common shares. Any questions? Any questions? Please, any questions? Am I too fast?
Oh,
No? Okay.
Professor,
So-
I have a question.
Sure.
Is it from the book or it is additional information?
Oh, I think you're gonna find some of them may not come from book, but some
Only fixed income parts. I didn't find it in the book.
the bond. So you can I think on the textbook you may not find the term fixed income, but bond market, bond, understanding bond. You may see the title bond. I think you may find the
Interest rates and bond valuation.
bond.
Okay, and also you mentioned that we have a practical midterm, so we need to solve questions, like solve tasks, and we don't solve a lot. Maybe we can have some more practical parts in our lesson just to practice before the exam.
Sure. So we want to definitely have the review class before before exam. Okay. But on syllabus, I said that there are 3 exams, 2 midterm exams, 1 final. But because of there is some students who participate in the UCRZ. So you're gonna have. I'm gonna change the syllabus. So I expect only 2 exams. So only 1 midterm exam, 1 final exam, and even the midterm exam may be late October or maybe late October, because after the event, UCRZ event. Okay, so I'm gonna change the syllabus and make some.
I meant just maybe. I meant not the review sessions. Just like when we finish with some topic, maybe we can do some practice tasks that might help us to understand, like we did today, but a little bit more.
Yeah, sure. So I definitely I'm gonna like this. Right? You wanna take some example and solve some questions to practice, right? Our understanding, right? Definitely, I agree. But before that, I want you guys to have some the fundamental understanding of the topic. That's my most principal task. And then definitely, as I said before exam, there will be at least 2 sessions of reviewing and tackling some questions related to the topic. Definitely, yeah, definitely. Otherwise,
I got it. Thank you.
Otherwise, I guess you guys gonna be a little bit, mad, right?
Excuse me, I got a question regarding the syllabus. So I wonder, what is the grade structure of this class? I mean, what is the lowest required amount of points to pass this class?
As I understand that there's a specific rules of the score. I mean, there's a maximum percentage of a maximum percentage.
Yes, I am aware.
I definitely follow that the criteria, the rules. So, well, I tried to give you the maximum. I tried to reach the maximum in terms of giving you the credits. So
Understand, but the amount required to pass this class is like, is it 51% or is it I don't know if it's different.
There's no absolute the scores. It depends on your relative performance.
Okay.
Yeah, no absolute. So your previous score may have some absolute standard, but I don't have absolute standard because I'm not sure definitely what level you are in right now. So it's going to be a little bit flexible. Any other questions?
Professor, I have a question.
Mm-hmm.
There are some examples on the slide, right? So if I solve the problem, then I don't know that one is right or not. So can you please upload the solutions about the examples?
Sure. Yeah. This example. Yeah. Okay. So yeah. I'm gonna say. I'm gonna explain. This is kind of yeah. I'm gonna give you some explanation. Okay, in the next class. Okay, about this example. Yeah. So I'm gonna take some time. I'm gonna take it easy a little bit, and then making sure you guys really understand what I'm talking about. Yeah. So I'm gonna also take a discussion in the next class, and this one make it a little bit easier. And yeah. So today we're gonna let me. So any other questions before I continue on the fixed income? Basically, I don't know. I tried to make you guys understood it a bit easier on this topic. So I tried. I take some stuff from outside of the textbook. So, but if you're struggling understanding, if you're struggling to understand the topic, then please email me whenever you need, or ask me during this class. So then I try to explain yeah, a little bit more. But I have a limited time, so that's my problem. Types of fixed income, we have mainly corporate bonds and government bonds. Fixed income is bond, right? Mainly bonds. But preferred stock could be also classified as a fixed income, preferred stock. Unlike a common stock, okay? So when you talk about stock, when I say stock, it means the common stock, right? Preferred stock is the stock, but the preferred stock stockholders are supposed to receive specific amount of dividend from the company at a fixed every year. Okay, so depending on the conditions, sometimes the amount that you haven't received at a specific year will be accumulated. So in one way or another, the preferred stockholders are supposed to receive the fixed amount every year, and sometimes preferred stock usually do not have a maturity, but some may have. So that's why I mean the nature of a preferred stock is very similar to the corporate bonds or government bonds. So that's why preferred stock also classified as bond fixed income. Mortgage-backed securities and certificate of deposit also fixed income because they all pay interest. Bond exchange traded bonds and mutual funds could be also fixed income. Okay, so issuance of why the companies issue bonds, because they raise capital to materialize their best ideas, to run the companies, or sometimes to expand their company, right? They need capital through issuing bonds. So you can read this part from I took from Microsoft Annual Report 2021. This is the latest one. So why they issue bonds? Okay. So you also need to be a little bit familiar with some bonds related terms, such as coupon rate. What is a coupon rate? Coupon rate is interest rate of interest payment stated on the bond. For example, 5%, 10%, something like that. Okay. And the maturity is a specific date of when the principal amount is repaid. Okay. And the year to maturity. This is important. Year to maturity. Year to maturity is total return that will be paid out by bonds by bond maturity. At bond maturity, so year to maturity is okay. Year to maturity is basically you purchase bonds and you keep this bond until the end of the period, until the end of the maturity, right? So then you wanna receive the principal amount, and you also have received interest amount. So based on your purchase price of the bonds and the principal amount and interest amount, you can calculate yield to maturity. So we're gonna keep talking about yield to maturity in the later slides. So don't worry about this concept right now. So I'm gonna keep talking about this yield to maturity. So you're gonna make a little bit. You're gonna have a better understanding as we move forward. And the bond indenture is a contract. Okay, bond contract on the bond. The contractual original agreement between corporations and its creditors. Okay, it's the bond issuer and the bond holder. Okay, contract. Indenture, right? Indenture. This is the indenture. Tesla issued some bonds, right? Pretty long time ago. And then if you look at this indenture or contract, bond contractual agreement, then you can find the basic terms of bonds, and the total amount of bond issued, and the description of a property used as a security, collateral, and the repayment arrangement and the core provisions. We're gonna talk about core provisions later. Details of the protective covenants. Okay, collateral on any asset pledged as on a debt, including bond to secure payment of debt. This is a description of property used as a security. This is a collateral. This property is collateral. Okay, asset pledged on a debt, including bond, to secure payment of debt. Covenant. Covenant is here. Covenant. Protective covenant. Covenant is as a part of the indenture to limit to specify certain actions of the issuer. Basically speaking, covenant is put some limitation on the bond issuers to protect to secure the interest payment to the creditors. Because, for example, in the covenant, there's maybe some ceiling amount. There's a ceiling amount of that the issuer can borrow from other investors. So if the issuer issue too much bonds, then the financial stability, financially the company is not stable. Then the creditors may run the risk of not receiving any interest payment and the repayment of principals. Okay, so covenant is limitations put on the bond issuers as a way to protect creditors against too much debt or some reckless actions by the bond issuers. Debenture is unsecured bond, and the default is failure of paying interest on time, and the bond rating is credit quality of a bond that leads to customer borrowing for an issue. Okay, this is just kind of a general terms you need to familiar with for bonds. Okay, on this topic, bonds. I think I'm going too faster, but I want you guys to engage. Hey, are you guys fine? Are you guys okay? Are you guys following me? Okay.
A bit too fast.
You a bit lost? Okay. From where? From
No, I mean a bit too fast.
a bit too fast.
But yeah.
Yeah, I also fear. I'm very hot. I'm very hot. Okay. Don't have to memorize this all these terms. Okay. The one thing you should take away from this lecture is that the nature of a bond. The nature of a bond. Bond is the fixed payment of interest, or in case of prepared dividends, prepared stock. Prepared stock. The fixed payments on a fixed schedule, and the bond also has a maturity. That's the key. Okay, that's the key you should take away. And if you have time, please try to read this slide and try to familiarize with these terms. Okay, and yield to maturity. Yield to maturity. I'm gonna come back here later. Okay, and this one, bond price and interest rate. First, before this, let me. Okay, bond market. So let's say bond was issued, right? So then let's talk about bond market. Bond market is, we do not have any specific bond market like New York Stock Exchange or something like that, right? As I said, it is over-the-counter market. Over-the-counter market means that on the future market, right? Mainly the market mainly consists of some dealers or brokers, not individual investors, the private individual investors, because the size of the investment, the size of the volume and size of the amount is pretty huge. So, okay, so company A need some money. They need capital. They need a capital to expand their business, right? So one way, so they come up, so they decided to issue bonds rather than issue a stock. Okay, so they issued the bonds, but the company always needs some help. Okay, because they don't have expertise in issuing bonds. So then investment bank, IB, comes in to help company A issue bonds to the investors, right? You may heard about many investment banks like Morgan Stanley, Goldman Sachs, right? Barclays, right? So and the Deutsche Bank, right? So then in the assistance of the investment bank, the company A issues bonds, then there will be investors, right, to purchase these bonds. So this initial purchase of these bonds, right? This initial there's a market where this initial purchase of bond is taking place. This market is called the primary bond market. Primary bond market. So when the new bonds are issued in this market, when new bonds are issued, the investors will buy this newly issued bond. So in this market is called the primary bond market. Okay. But once the bonds are purchased by the investors, they may not keep these bonds to the maturity. They may sell to other investors who are interested in this bond, right? So these bonds are actually traded among many other investors. This is the secondary market, secondary bond market. So we are gonna talk about the changes in bond prices in the secondary market. Okay, so like a stock, bonds are also traded in the secondary market. This stock market, New York Stock Exchange, this is primary market plus the secondary market, right? Why? IPO initial public offering. This is in terms of stock. IPO is the is a process of offering newly issued shares to the investors, right? So that IPO is the initial purchase of shares, right? So in that sense, that is the that's the primary the New York Stock Exchange is because for example, New York Stock Exchange, many companies offering their shares here in New York Stock Exchange. So New York Stock Exchange can be a primary market, but after investors are purchasing the shares, they also trade the shares with others, right? So then New York Stock Exchange can be also a secondary market, right? But bond market, we don't have any specific market like New York Stock Exchange. So once the bonds are purchased primarily by investors, then those investors is gonna not holding the bonds to the maturity, but before the maturity they're selling the bonds to other investors depending on interest rate, market interest rate. Okay, why do they sell the bonds? Because of the interest rate, market interest rate. They compare. We have two types of interest. One interest is coupon rate. Coupon rate is interest rate offered by bond, right? Versus market interest rate. So investors who purchased the bonds initially compare this coupon rate with the market interest rate. So to maximize their profit based on the market rate, they sometimes sell bonds or sometimes purchase bonds from the other investors, right? So this the relationship between market interest rate and the bond coupon rate, the relationship between the two the changes the bond price. Okay. Let's say coupon rate is 5%. This coupon rate doesn't change. Okay. Once when the company issue a bond, the coupon rate is fixed, but market interest rate always changed, right? So, okay. So I'm going to talk about further on the relationship between coupon rate and the market rate in the next class. Okay, so this slide I'm going to also talk about yield maturity, and I'm going to also explain this slide and this relationship and the term structure. Okay, so in the next class, I'm gonna start from here. Okay, any questions? We have 2 minutes. Any questions or any suggestions? If I'm too fast, or any suggestions or any questions or whatever. I'm open to everything, except for giving you guys answers to the exams. Okay.
Professor,
Yeah.
can I ask you a question? Why the principal amount is like much valuable than remaining amount?
Principal. Sorry, say again.
You said before that the principal amount is like more higher or no, more important than remaining amount.
Principal. Sorry, I could not get your point. Could you say again?
I'm asking why principal amount has a higher priority than remaining amount.
Here.
Yep.
Why the principal amount and interest are higher priority? Yeah. Basically, as I said here, once the company issue bonds, then the amount that they borrowed from the creditors comes into this liability side, right? And then using this bond, using the money financed through bonds, they're gonna purchase assets. But interest payments also, this is a priority compared to the shareholders. Okay, priority over shareholders. So here the equity is asset minus liability, right? So this equity section is a shareholder section. So compared to shareholder, when the company repays repays to creditors or shareholders, they first repay to creditors, and then any remaining amount goes to shareholders. That's why this interest and principal amount has a higher priority over shareholders, common shareholders.
Okay, thank you.
Yeah, and even interest expense deducted first before net income, which goes to shareholders. Okay. And so some students have a next class. So see you next Tuesday, and have a great Chuseok, Thanksgiving, Korean Thanksgiving Day. Okay. Any questions? No? Okay. See you next Tuesday. Bye-bye.
Thank you,
Thank you,
Professor.
Professor.
Thank you, Professor. Goodbye.
Bye-bye.
Thank you, bye.
Thank you. Bye.
I have some personal questions.
Okay.
This Tuesday, and I didn't join this class because I was on the plane, and I haven't just have your email. I haven't send an email to you. So am I to write a leave application later, or so what?
So you are worried about your attendance rate?
Yeah.
Yeah, I'm gonna make sure you attended the previous class.
Okay, thank you.
Yeah. So you're receiving my email, right? Invitation email.
No, because I haven't to find your email address.
If you go to LMS and then it's syllabus, then there's my email.
Oh, okay.
Okay. See you next
Okay.
Tuesday.
Okay, thank you, Professor.
Thank you. Bye bye.
I
Bye.
have also one question.
Yeah.
So I was present at the class and I was trying to do my attendance in the school app, but it didn't let me go through. I was trying it for many times to
Hmm.
check my attendance. I don't know
Okay.
why.
So I'm gonna make sure you're also attending the previous
Okay.
classes.
But the thing is, I was actually asking you the same. I was telling you the same issue last class. I don't know why it doesn't work. I don't know if it's the same with other students, but well, the app doesn't work for me to check in for this course.
Okay. Okay. I have no idea about the apps that you are
As I
using.
understand, I'm just trying to explain the.
Oh,
I am
okay.
present. So far, I was present at every class, but
Yeah.
I don't know why it doesn't let
The
me.
one thing I can for sure do is that I'm gonna make sure you attended the previous classes. But if there's any technical problems, then I don't know. So I'm going to the attendance site, and then try to make sure you attended the previous class.
Oh, all right.
That's
all
what
right.
I can do.
I will try to contact the technical team.
Okay. Thank you.
Okay. Thank you very much.
You
Have a
too.
nice day.
Yeah,
Bye.
you too. Bye bye. Okay. Thank you. Bye bye.